At exactly 9:30 this morning, a phone rang inside J.P. Morgan Chase headquarters on Madison Avenue. On the other end was a margin clerk from the CME Group, demanding $4 billion in immediate liquidity. By 11:08 a.m., that money still hadn't arrived. For the first time in American history, the world's most powerful bank had missed a margin call. And what happened next will rewrite everything you thought you knew about the safety of your money. The thing about margin calls is that they're supposed to be routine. You know, it's like paying your credit card bill. Annoying, maybe, but necessary. Banks wire the money, the exchange confirms receipt, and the game continues. Except today, the wire didn't come. 10 salto M. Passed. Then 10:30. By 11 o'clock, whispers started circulating across trading floors from New York to London. Something was wrong. The king of American banking, the fortress that had stood unshaken for over a century, was wobbling. To understand the absolute terror gripping Wall Street right now, you need to understand what this margin call actually represents. When you trade with leverage, when you borrow money to amplify your bets, the exchange requires collateral. Real cash. Not promises, not IOUs, not trust me bro. Actual liquid capital sitting in an account. If your trade moves against you, your collateral evaporates. The exchange then issues a call for more cash to cover the bleeding. If you can't pay within the hour, they seize control and liquidate everything you own to settle the debt. J.P. Morgan just admitted, in the most spectacular way possible, that they don't have the cash. How can a bank with over $3 trillion in assets not scrape together $4 billion in cash? The answer exposes the dirtiest secret in modern banking. A secret that puts every dollar in your savings account at risk. Here's what they don't teach you in economics class. Banks don't actually have your money. They have assets. They've got real estate holdings, long-term government bonds, mortgage-backed securities, and a derivatives portfolio so complex it would make a quantum physicist weep. But cash? Actual spendable, movable cash. That's in dangerously short supply. This is the magic trick of fractional reserve banking. They take your deposit, lend out 90% of it, keep a tiny fraction on hand, and pray to God that you never asked for it all back at the same time. It's a confidence game that only works as long as everyone believes the illusion. When silver prices exploded to $85 this morning, J.P. Morgan's short positions their billion-dollar bet that silver would crash went catastrophically wrong. Their liabilities skyrocketed while their bond portfolio, already beaten down by rising interest rates, cratered in value. They found themselves in what economists call a liquidity trap. Asset-rich on paper, but cash-poor in reality. And in a margin call, only one thing matters. Cash. The missed payment proves something that banking regulators have been desperately trying to hide for years. The emperor has no clothes. J.P. Morgan is operating on fumes, propped up by accounting tricks and the promise of federal backstops that may not arrive in time. Because J.P. Morgan failed to meet the call, the CME Group, the exchange, is now legally required to do something that will send shockwaves through every market on Earth. They must liquidate J.P. Morgan's positions. Immediately. This means computer algorithms will start executing automatic buy orders for silver. Billions of dollars worth. And here's the kicker. They don't care about price. The algorithm just hits market buy over and over until the position is closed. It's mechanical. It's ruthless. It's unstoppable. We are about to witness a forced buying spree that will send silver prices vertical. I mean, we're talking about a price explosion that could smash through $100, maybe $150, before the trading day ends. Every hedge fund on Wall Street can smell it. They're front-running the liquidation right now, buying silver because they know J.P. Morgan must buy it later at whatever price the market demands. This is a super squeeze. The default of the short seller becomes the victory of the long holder. And if you're holding physical silver right now, you're sitting on a winning lottery ticket while the casino burns down around you. J.P. Morgan doesn't exist in a vacuum. They are the counterparty to almost every other major bank in the world. If they can't pay their debts, the dominoes start falling. And the first domino has already begun to tip. This is what keeps central bankers awake at night. Counterparty risk. It's the idea that, in our hyper-connected financial system, The failure of one institution triggers a cascading collapse of everything connected to it. JP Morgan can't pay Bank of America. Bank of America can't pay Citigroup, can't pay Deutsche Bank. It's a chain reaction tearing through the global banking system faster than regulators can contain it. We're already seeing spikes in the overnight lending rate. The rate banks charge each other for short-term loans, indicating that trust has evaporated. Nobody wants to lend money to a corpse. The credit markets have frozen. The repo markets, which are the plumbing of the financial system, are seizing up just like they did in September 2008. And we all remember how that story ended. Reports are coming in of an emergency meeting taking place right now at the Federal Reserve Building in Washington. Helicopters spotted on the roof. Jerome Powell and the Board of Governors are locked in a room, deciding the fate of the global economy. They have two choices, and both of them are catastrophic. Choice 1. Let JP Morgan fail. Watch the dominoes fall. Trigger a depression that makes 2008 look like a minor correction. Let the free market work. Consequences be damned. Choice 2. Print trillions of dollars, maybe 5, maybe 10 trillion to bail out the bank and every institution exposed to it. Sacrifice the purchasing power of the dollar to save the casino. Guarantee hyperinflation in exchange for temporary stability. Guess which one they're going to choose? Actually, you already know. They always print. They printed in 2008. They printed during COVID. They'll print today, and when they do, it will mark the beginning of the end for the US dollar as a store of value. We're about to witness the greatest wealth transfer in human history, and most people won't even realize it's happening until their grocery bill doubles. Now let me tell you something that your bank definitely doesn't want you to know. If JP Morgan is insolvent, and this missed margin call strongly suggests your deposits are at risk, under the Dodd-Frank Act of 2010, when a systemically important bank fails, regulators can execute what's called a bail-in. This isn't a typo. Not a bailout where taxpayers foot the bill. A bail-in. They take the money in your savings account and convert it into bank equity. Shares. You become a shareholder in a bankrupt institution instead of a depositor with cash. Think about that. The money you've spent years saving, the emergency fund you've built. The nest egg you've protected, it can be legally seized and transformed into worthless stock certificates in a failing bank. You're not a customer. You're an unsecured creditor, and creditors are last in line when the building burns down. This missed margin call is the trigger event. If you have significant money in any major bank right now, you're holding a live grenade. Get your money out. Move it to a local credit union, convert it to physical assets, or withdraw it as cash, but do not leave it sitting in the blast radius. The ATMs still work. For now, I want you to consider something that mainstream media will never discuss. Do you think it's a coincidence that this happened right after China spent the last 6 months systematically draining silver from Western vaults? China played the long game. They bought physical metaltons of it while JP Morgan held naked paper shorts. Then, with exquisite timing, they pushed prices up in Shanghai, forcing the margin call in New York. This was a calculated financial assassination. China just bankrupted the American banking system without firing a single missile. They exposed the leverage, called the bluff, and pulled the rug out from under the dollar. For 100 years, JP Morgan represented the strength and stability of American finance, the fortress balance sheet, the institution too powerful to fail. Today, at 9:30 a.m., that fortress crumbled into dust. The psychological impact of this default cannot be overstated. If JP Morgan isn't safe, who is? This question is racing through the minds of depositors across the country right now. We're about to see bank runs spread through the regional banking sector like wildfire. People will pull their money out of everything and stuff it into the only assets that don't rely on a banker's promise: gold, silver, and maybe Bitcoin. The era of blindly trusting the financial system ended at 9:30 this morning. Jamie Dimon, the CEO who mocked Bitcoin as a fraud, who laughed at silver investors, who assured the world that JP Morgan's risk management was flawless, is conspicuously silent. He's likely been removed from operational control by regulators. His arrogance leveraged the bank to breaking point, betting that the Fed would always ride to the rescue. He was right about the Fed's willingness. He was catastrophically wrong about the timing. Turn on CNBC right now. Are they calling it a default? No. They're using words like liquidity glitch and technical delay. They're interviewing banking analysts who solemnly assure viewers that the system is, well, capitalized and stable. They said the exact same thing about Lehman Brothers, 48 hours before it went to zero. They said it about Bear Stearns. They said it about every bank that failed in 2008. The media's job is not to tell you the truth. Their job is to prevent panic long enough for insiders to move their money to safety. By the time they admit the crisis is real, it'll be too late for you to act. The truth is in the numbers. The numbers say the bank is broke. There's another dimension to this crisis that should terrify you most. JP Morgan holds over $50 trillion in notional derivatives exposure. That's more than the GDP of the entire planet. These are bets on interest rates, currency exchange rates, and commodity prices, interconnected contracts tying JP Morgan to thousands of institutions in a web so complex that nobody fully understands it anymore. A $4 billion margin call failure is the spark that ignites this $50 trillion powder keg. If JP Morgan cannot honor these contracts, global clearinghouses collapse. We're not talking about a recession. We're talking about a financial nuclear winter where international trade grinds to a halt because nobody trusts anyone else's ability to settle transactions. The tragedy here is that this won't just hurt bankers. JP Morgan acts as custodian for trillions in pension fund assets. Teachers, firefighters, public workers who spent careers saving for retirement. Their assets are now frozen in legal limbo. With the bank in default, those assets get seized under bail-in provisions to stabilize the balance sheet. Your retirement didn't vanish. It was confiscated to pay for Jamie Dimon's gambling addiction. Meanwhile, the stock market hemorrhages, the S&P 500, the Dow, they're in free fall, as algorithms dump equities to raise cash. Tech stocks that survive on cheap credit are being obliterated. If you're holding stocks today, you're clutching tickets to the Titanic after it struck the iceberg. We expect an official announcement after markets close at 4 p.m. today. They'll announce a bank holiday to prevent withdrawals. Once that happens, your digital money is trapped inside a failed system. You have hours, maybe less, but chaos is also opportunity. While the masses panic, wealth is transferring to those who hold hard assets. Silver at $85, even at $100, is still cheap in a world where the banking system collapses and governments print currency into oblivion. Gold has already shattered its all-time high, crossing $3,000 an ounce as central banks dump dollars. They know what this means. Gold is remonetizing in real time. If you're holding physical silver and gold right now, you're holding the currency of the future. The system has failed. The reset is here. The dollar is dead. Long live silver. The events of today will be studied for generations. January 5th, 2026. The day the illusion finally shattered. The day paper wealth collided with mathematical reality. The lesson is simple but brutal. If you can't hold it in your hands, you don't actually own it. Those digital numbers in your bank account were never real money. They were yours. And today, the issuer went bankrupt. Do not trust the recovery. Protect yourself, protect your family, and watch history unfold in real time.